Okay, so this is for the subject capital markets, and the topic for this video is about primary market. Okay, so again, we have here an article from investopedia.com. Let's begin with the definition. What is a primary market? So it is a source of new securities. Okay, new securities. Essentially, the parties involved here are the issuer of the securities, essentially the government if it's treasury bills, or private companies if it's equity, ordinary shares, or preferred stocks, or what do you call this, bonds, right? So often in an exchange, it's where companies, governments, and other groups go to obtain financing through debt-based or equity-based securities. So debt-based, we have the bonds, and then equity-based, we have the preferred shares or the ordinary shares. Okay? Primary markets are facilitated by underwriting groups, normally investment houses or brokers or banks or financial institutions, consisting of investment banks that set a beginning price range for a given security and oversee its sales to investors. Okay? So normally, the company or the government would require the services of an underwriter. Okay, and then it's the underwriter that's going to seek the investors. Normally, they do have, a clientele or group of clients who are investors, who are, seeking companies, seeking government bonds. So it's a little easy for them to find a market for the securities, right? Once the initial sale is complete, further trading is conducted on the secondary market. Secondary market, it's a trade between an investor and another investor. So essentially, why does that happen? If an investor no longer wants to hold on to the security, let's say he has an immediate need for money or for cash, then he would have to sell it to someone else. Normally, he can't sell it back to the company or to the government. So what he'd look for is another investor who'd like to invest for that particular company securities or government securities. Okay, so it's a trade between an investor and another investor. So that's what we call the secondary market. Okay, and that's where the bulk of exchange trading occurs every day. And in a way, it helps with the liquidity of that particular security. Liquidity is convertibility to cash. Okay. Key takeaways: in the primary market, new stocks and bonds are sold to the public for the first time. Okay? In a primary market, investors are able to purchase securities directly from the issuer, but sometimes through an underwriter. Types of primary market issues include an initial public offering, a private placement, a rights issue, and a preferred allotment. Stock exchanges instead represent secondary markets where investors buy and sell from one another. After they've been issued on the primary market, securities are traded between investors on what is called the secondary market, essentially the familiar stock exchanges and other markets as well. Understanding the primary markets, it is, again, where securities are created, sold for the first time directly from the issuer. It's in this market that firms sell or float new stocks and bonds to the public for the first time. Companies and government entities sell new issues of common and preferred stock, corporate bonds and government bonds, notes and bills on the primary market to fund business improvements or expand operations. Okay, that's normally the reason for issuing the securities to get additional funds. Although an investment bank may set the security's initial price and receive a fee for facilitating sales, most of the money raised from the sales goes to the issuer, of course. The primary market isn't a physical place. It reflects more than the nature. It reflects more the nature of the goods. Okay? The key defining characteristic of a primary market is that securities on it are purchased directly from an issuer and for the first time, as opposed to being bought from a previous purchaser or investor, which is, essentially second-hand, so to speak. That's why it's also called secondary market. Okay. Investors typically pay less for securities on the primary market than on the secondary market, because in the secondary market, it's already affected by supply and demand. Investors, how many investors are willing to get this particular investment or security, and then of course performance. Sometimes it's tied to the performance of the company. Are they doing well? Normally, it would help in increasing the value of the stock, normally the stock, okay? But with regards to bonds, normally their value are not affected by company performance, okay? All issues on the primary market are subject to strict regulation, especially IPO. IPO is through stock exchange, publicly listed, okay? So they would have to file with SEC and of course PSE and other securities agencies, and must wait until their filings are approved before they can offer them for sale to investors. After the initial offering is completed, that is, all the stock shares or bonds are sold, that primary market closes. Okay, those securities then start trading in the secondary market. Types of primary market issues. So at an initial public offering or IPO, it's an example of security issued on a primary market. An IPO occurs when a private company sells stocks to public for the first time, okay, known as going public. The process, including the original price of the new shares, is set by a designated investment bank or broker or underwriter hired by the company to do the initial underwriting of that particular stock. Okay, so here's an example. You can read this one. A rights offering issue permits companies to raise additional equity through the primary market after already having securities enter the secondary market. Okay, current investors are offered prorated rights based on the shares they currently own, and others can invest anew in newly minted shares. Okay, so if they wanted to raise, they already raised some capital, but they realized, not enough, or we can do more, or we can expand more, so they make additional, they raise additional equity, okay, through an additional rights issue or rights offering. Other types of primary market offerings for stocks include private placement and preferential allotment. So normally for preferred stocks, private placement allows companies to sell directly to more significant investors such as hedge funds and banks without making shares publicly available. So not only individual investors can buy securities. So we have, investment houses, we have hedge funds, we have banks, and then we also have corporations that invest in other company shares, right? We have GSIS, SSS, PhilHealth, like EB. They do invest some of their funds into the stock market, but most are actually invested in the bonds, okay, issued by the government or by private companies, okay. At a special price not available to the general public. This is for preferential allotment. Offer shares to select investors at a special price. Similarly, businesses and governments that want to generate that capital can choose to issue new short and long-term bonds on the primary market. New bonds are issued with coupon rates that correspond to the current interest rates at the time of issuance, which may be higher or lower than those offered by pre-existing bonds. Okay, and then we have the comparison. Again, primary market, first issue directly from the issuer, secondary market, from an existing investor to, another investor, okay? What else? Secondary markets are further divided into two types. Auction market, open outcry system where buyers and sellers congregate in one location and announce the prices at which they are willing to buy and sell their securities. Dealer market, participants in the market are joined through electronic networks. The dealers hold an inventory of security, then stand ready to buy or sell with market participants, okay? Again, the key distinction between primary and secondary markets: the seller or source of the securities. Direct from the issuer, primary; secondary, investor to investor, secondary, okay? And then you have here example of primary market. Okay, in 2017, Republic of Argentina selling $2.75 billion worth of debt in a two-part US dollar bond sale. Funding was going toward liability management purposes. Joint underwriters included Morgan Stanley, Bank of America, Merrill Lynch, Deutsche Bank, and Credit Suisse. It marked the first time a junk-rated government, Argentina, had only returned to the debt markets the previous year after massive defaults had barred it for a while. Offered century bonds. Wow! Century bonds, 100 years ang maturity. Okay. Facebook's initial public offering in 2012, largest IPO of an online company, largest IPOs in the technology sectors in US history. Expectations were high. Many investors believed the stock's value would very quickly increase on the secondary market due to the company's popularity and rapid success. Because of high demand in the primary market, underwriters priced the stock at 38 pesos per share at the top of the targeted 35 to 38 range and raised the stock offering level by 25% to 421 million shares. That's a lot. The stock valuation became 104 billion, the largest of any newly public company. Okay, they're very successful during that time. Although Facebook raised $16 billion through the primary market, the stock did not greatly increase in value the day of the IPO. It closed at 38.23 after 460 million shares were sold and turnover exceeded 100%. Facebook actually went significantly lower later in 2012, hitting an all-time low 17.73 on September 4, 2020. Okay. A lot of things happened 2012 to 2020, right? But it recovered thanks partly to the company's heavy focus on its mobile platform. If you invested $10,000 in the company at its IPO, you would have received 263 shares of Facebook common stock. As of April 21, 2021, those shares were selling for $301 apiece, making your investment worth $79,163. Okay, in retrospect, that primary market purchase of 38 per share seems like a discount, right? Okay, facts. Frequently asked questions. What is the primary market and secondary market? Again, just to reiterate, if it's first time issue directly from the issuer, it's primary market. If it's from another investor to another investor, it's the secondary market. Okay. In the primary market, the proceeds go directly to the issuer, so the issuer, the company, or the government, receives the money, whereas in secondary market, the money or the sale is being exchanged between investors and does not in any way affect the company. Okay. Types of primary markets, we have initial public offering, rights issue or offering, private placement, and preferential allotment. Role of the primary market marks the launch of a new security, corporate stock shares, or a bond into the financial marketplace. Enable companies and governments to attract investors and raise money to pay debts or to expand. Normally, if the reason for raising capital is to pay debts, the price is going to be quite low. But if it's for, expansion, then the price is going to be quite high. All right. They also enable investors with assets to put their money into, generate income, or get in on the ground floor of a promising young venture. What is the primary market and secondary market in India? Okay, you can read it if you're interested. Bottom line, a primary market is a figurative place where securities make their debut or introduction into the market, where new bonds and shares of corporate stock are issued to be sold to investors for the first time. They are sold by the companies, governments, other entities issuing them, often with the help of investment banks, brokers, but more commonly called as underwriters, who underwrite the new issues, setting their price and overseeing their launch. There is a primary market for most types of assets, with equities or stocks and bonds being the most common. And there are several other types of primary market issues, familiar with IPOs, and then you have your private placements and rights offerings. Most primary market buyers are institutional investors, though individual investors can get easily in on certain offerings, like the U.S. Treasury bonds. After they've been issued in the primary market, existing shares of stock, bonds, and other securities are traded between investors on what is called secondary market. Okay, essentially the familiar stock exchange and stock market. All right. So essentially, we've already covered secondary market as well, but we're going to have a separate video for that. Okay. So that's it for this one. Thanks and bye.